Today we're going to explore working capital management, which is all about managing a company's short-term finances to maintain a healthy cash position. This involves balancing assets like trade debtors and stock, along with liabilities such as trade creditors. Effective working capital management helps ensure the company can meet its day-to-day obligations while maximizing cash available for operations and growth. If a business faces short-term working capital issues, it might delay capital projects, encourage quicker payments from debtors, sell assets, negotiate longer payment terms with suppliers, or cut dividend payments. On the other hand, holding cash is important for daily transactions, unexpected needs, and taking advantage of business opportunities like acquisitions. One key area we'll focus on is managing trade debtors through credit terms and invoice discounting. For example, if a company with monthly sales of £3 million and variable costs of £2 million decides to extend the credit period to customers from 30 to 60 days, this decision impacts cash flow and overall working capital, setting the stage for strategic financial planning. The current trade debtors balance is just under £3 million, calculated by taking monthly sales and adjusting for the current 30-day credit period. If the credit terms were extended to 60 days, with sales increasing by 20%, trade debtors would rise to about £7.1 million. This increase of over £4 million would have to be financed at the company's 12% cost of capital, costing nearly £500,000 annually. However, the additional sales would contribute £2.4 million towards fixed costs and profit. When we weigh these factors, the net benefit of extending credit appears positive at just over £1.9 million per year, suggesting the extension could be financially worthwhile. Next, we consider invoice discounting or factoring, where up to 80% of trade debtors can be advanced by a financial institution as invoices are issued. The remaining amount is paid once customer payments are received. For example, if a company discounts £10 million of invoices with a 75% advance and pays a 17% fee upon settlement in 60 days, we can analyze how this affects cash flow and costs in comparison to managing trade debtors internally. In this example, 75% of the £10 million invoiced is advanced immediately by the factoring company when the invoices are presented, which amounts to £7.5 million. Over a 60-day period, the cash is collected from the customer, and the factor charges a 17% fee on the total invoice amount, which is quite significant. Looking at the cash flows, the company initially receives £7.5 million, then collects £10 million from customers, but after paying the factor's fee of £1.7 million, the net cash flow reflects the costs involved. This highlights that while invoice discounting provides quick access to cash and helps improve short-term liquidity without affecting the company's borrowing capacity, it comes at a relatively high cost compared to other financing options. On the plus side, it can also reduce administrative efforts and the burden of cash collection. Moving on from financing, strategic management of stock through approaches like the reorder system and just-in-time inventory can further support working capital management. These techniques aim to balance when and how much stock is ordered to avoid excess holding costs while ensuring supply meets demand effectively. To understand the stock control system, we first need to look at the costs involved with holding inventory. Ordering costs are fixed expenses associated with each order placed, which influence how often a company might reorder stock. Purchase costs only impact stock decisions if suppliers offer discounts when buying larger quantities. Holding costs can be fixed, like warehouse rent, or variable, like the cost tied up in financing the stock itself. This latter cost, the cost of capital, is especially important since it represents money that could be used elsewhere. The classical stock control system, which most businesses use, takes into account a few key factors. One is the reorder lead time, which is the delay from placing an order to when stock arrives. Another is the economic order quantity, or EOQ, which is a formula used to find the best balance between ordering too much or too little stock. Demand forecasting is also crucial because knowing how much product you expect to sell helps guide ordering decisions. This forecasting can be simple or more complex depending on how predictable demand is. To bring all this together, we will look at an example where for a product costing £100, with an annual demand of 2,000 units, an order cost of £20, and a 12% capital cost, we calculate EOQ and reorder timing. The delivery lead time for this product is 3 weeks, meaning 3 weeks elapse between ordering and having the stock available. This example will show how to determine how much to order and when, using the classical stock control system principles. The economic order quantity, or EOQ, is the point where the costs of ordering and holding stock are at their lowest. It's calculated using the formula that takes the square root of 2 times the order cost per unit multiplied by annual demand, divided by the stock price per unit and the cost of capital. For example, with an order cost of £20, annual demand of 2,000 units, stock price at £100, and a 12% cost of capital, the EAC would be 82 units. The reorder level tells us when to place an order, based on the demand during the supplier's lead time. This is calculated as annual demand divided by 52 weeks, then multiplied by the lead time in weeks, in this case, 115 units for a 3-week lead time. The just-in-time or JIT stock control system aims to minimize stock levels by receiving goods only as they're needed, which reduces holding costs but requires very reliable suppliers and strong relationships with them to avoid stockouts. For companies with multiple products, it's practical to use commercial software that captures data through methods like electronic point-of-sale systems and barcoding, ensures calculation accuracy for EAC and reorder levels, and integrates with other systems such as purchase orders, goods received notes, and accounting ledgers. These considerations help maintain an efficient and accurate stock control system. Strategic initiatives around managing cash focus on forecasting cash flows and using short-term deposits wisely. Holding cash comes with a cost, mainly the lost interest that could have been earned if the cash were invested, but it also brings clear benefits. Cash ensures the company can cover daily expenses, handle unforeseen needs, and quickly seize opportunities like acquisitions. When a company has extra cash to invest, it needs to consider the rate of return, the risk involved, and how easily the investment can be converted back to cash. Various options exist, such as paying down an overdraft, which reduces interest expenses and offers a quick, low-risk return. Bank deposits provide a safe but low return, though they might require notice before withdrawal. Money market deposits offer returns based on maturity time but aren't very liquid. Government bonds are another low-risk, low-return choice with medium liquidity. Investing in stocks can bring higher returns but involves more risk, though selling shares is relatively liquid. Lastly, managing trade credit terms is also important. For example, if a supplier offers a 2% discount for payments made within 10 days instead of the usual 30, a company purchasing £8 million worth of goods needs to evaluate whether it makes financial sense to pay earlier and take advantage of that discount. By paying 98% of the £8 million invoice within 10 days, instead of waiting the full 30 days, the company effectively earns an internal rate of return of 47.42%. This is significantly higher than the typical weighted average cost of capital, meaning the early settlement deal creates value for the organization. Managing working capital well is crucial because it balances current assets and liabilities, ensuring enough liquidity to cover short-term payments while keeping costs low. This not only lowers financial risk but also improves profitability by using resources more efficiently and controlling costs. In the long run, strong working capital management stabilizes the business, increases cash flow, and provides flexibility to take advantage of growth opportunities, supporting sustained success.